Hello and welcome to Money, 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 your weekly personal finance date with me, Sumaira Abdi. You know, when we're dealing with money, it's easy to get overwhelmed because for most of us, finding that right mix between earning, saving, spending, and investing can take some time. But help is at hand. It is easy to keep it simple. Financial minimalism is possible, and even better, simplifying your financial life can actually reap major benefits. So helping us do just that and to declutter our finances is Mohit Gang, CEO and co-founder of Moneyfront. Hi Mohit, thanks very much for joining in. But the problem with keeping it simple is that a lot of people feel that they haven't done enough, right? So how do you debunk the myth that simple is not enough?
Hi, Sumaira. Always a pleasure to be on your show. So look, I'll just start by quoting Paul Samuelson out here, and he says that investing is like watching grass grow or watching paint dry. If you really want excitement in your life, then you take $1,000 and go to Las Vegas, right? And that's honestly the whole philosophy of investments. The more simple you keep it, the more boring it gets, the better it will be for you in the long run, right? And I think that's where the beauty lies. That if you really try and make it very complex, very exotic, you try and mix and do a lot of things, try and chop and churn, it becomes extremely meaningless and you end up losing money or end up paying high costs. So just keep it simple, keep it boring, and just let it grow by itself. That's the whole fundamental rule out there.
But is it enough? I mean, will it get you where you want to go?
Oh, definitely. Look, I think if you just don't touch, and most of the times, if you realize the investments which you have not touched for many years are the ones which will give you the largest amount of benefit. The compounding impact of those investments is massive, right? If you just keep it, let's say if you know your own abilities, if you know you're not the one who will sit in front of the screen day in and day out, who will track stocks, who understand cash flows, who understand balance sheets, who can't differentiate between return on equity and return on capital employed, then there is no point getting into stock markets. Just for an example, right? You are rather better off staying investing in a simple product like a mutual fund and staying the course for 10, 15, 20 years. They'll yield you higher results because the chances of you making mistakes are that much lower in this case.
Okay. But for a lot of people, what happens is that, we start off on our investment journey. We'll have our, the SIPs that we have set up, they go out. We may have some EMIs that are going out. But beyond that, if there is money coming in, we let our bank account sort of just keep building up, right? Is that healthy? I mean, that's keeping it simple, but does it work?
Okay, look, so out here, I think the end objective, Sumera, is that you have to cross the swamp and you have to not fight the crocodiles, right? Which is, again, going back to your first question, that you don't have to like really make it very exotic. But keeping cash for your emergency requirements, to me, is the most fundamental thing of personal finance, right? And many times you would find experts debating whether you should keep it in liquid or money market instruments or some FDs or something like that. But to me, that 6 months of confidence, which a cash balance in the bank account gives, is much more than anything else, right? So a 6 months to a 12-month kind of an emergency corpus kept simply in savings account or a sweep in FD, right? If you can do a sweep in FD, nothing like it. That's the best instrument available out there. But just plain simple cash also in the savings account for 6 months kind of an emergency is a good confidence booster and should be there.
Okay. And of course, having insurance would add to that comfort, right? But how do you sort of structure your insurance portfolio in a way that
of instruments which are available within that overall ambit of insurance is much more complex. The first fundamental rule is just do term insurance, plain vanilla life cover. Never go for anything exotic in insurance which is linked to investments or which is linked to some goals or which is some structure which gives you some bonus or something like that, right? So just keep it very simple, plain vanilla life cover. That's rule number one. Rule number two, Sumara, is that you need not buy a very huge insurance policy. I really differ with many advisors out here who advocate a huge cover. They will compute your personal liabilities, your family liabilities, your outstanding loans, your financial goals, and club the entire amount and make you buy a 2 crore, 5 crore, 10 crore policy. To me, you have to break it into 2 or 3 components. You have to define it goal wise. So if you have a goal, let's say for me, I have a goal for my daughter's education and her marriage. which is 15-20 years down the line, I will buy, and I know X amount is required for that. So I'll buy just one policy with X amount, which is, let's say, a crore kind of an amount for 20 years. That's about it. Once that goal is achieved, and if I live till then I don't have to save further for that, and I'll close that policy. I'll not keep paying that sinking premium every year. Second, my retirement goal. Now, simultaneously, I'm building an asset cover for that. I'm doing my SIPs, I'm doing my other investments to build a retirement corpus for myself, right? And if I think by the age of retirement, I have a sufficient enough asset cover, then I need not continue to pay for insurance. If I build a huge asset base for myself, then insurance actually doesn't serve much purpose after a particular asset base which you wanted to build in the first place. So you can forego that policy. So the right way is to ladder out your insurance, buy 2 or 3 policies, keep closing as you cover those financial goals, and just perhaps keep one ticking along to cover for any eventuality and give some support, financial support to your family and your near and dear ones in case there is any eventuality. But yeah, buying a huge policy doesn't work well for me.
Okay, no, that's an interesting point of view, and you have presented your argument as very well as well. But this is life cover, right? Health insurance is still something that we need to buy.
Oh yeah, definitely. That there's no compromise out there, and I think again the whole thing is people tend to take this thing very easy, which is a basic health cover. Now that is one cost which is not growing at the inflation rate, which is the health medical care cost is just not growing at 5-7%, is exponentially growing. It's growing at 10, 12, 15, 20% kind of this thing. So it is getting prohibitive. Now, two things out here. Every employer provides you a medical cover. If you are an employee, if you're a salaried guy, you're getting an employee cover, but you will keep changing jobs. You will not end up at the same place at your retirement and when you started your career. So you will change 2 or 3 jobs and your medical cover will also keep changing, right? And when you need it the most, which is near the retirement age, that's the time when you will lose it if you rely on your employer. So the whole thing is, quickly take a medical cover in your own personal capacity, a personal name, and that could be a family floater to start with, basically, which will keep accruing no claim bonus for you till you retire, and which will be your own policy, which carries on for the life of yours, right? So that's the most important and essential part, to have a medical cover on your own name.
Okay, fair enough. But, one problem that arises, and here is where things get complicated for most people, is when we spend more than we should, right? So I know there is this 50-30 rule about how you should divide the money that you have. But does this rule still hold? I mean, it's been, decades since somebody has thought of updoing it. So is it time to look at revising this rule, or will 50-30-20 is still a good sort of allocation for people here?
Like for starters, honestly, Sumaira, I think it works really well, right? It's a broad thumb rule. Obviously, it can't be like pasted on each and every individual, because everyone has their own personal, criterias or personal obligations in life to fulfill. So it has to be tweaked accordingly. But as a thumb rule, it works really well. However, I have a tweak to that. You start your career, or you start your earning career or your saving career with this rule, which is 50% for your discretionary 50% for your necessary expenses, which is your daily bread and butter, which is your food, your EMIs, your compulsory expenses, your rents, your bills, electricity, mobile, etc., right? 30% is your discretionary and your lifestyle expenses, which is the way you shop, your restaurants, your clubbing expenses, so on and so forth. And 20% compulsorily has to go to investments, which is called in personal finance language, it's called paying yourself first, right? So you pay yourself first, which is you give 20% to your own corpus building, wealth creation, retirement goals, and you keep it aside for investments. But the whole thing is, you don't keep this formula static. You keep moving the needle with every passing age or decade in your age, right? So it has to keep moving. And by the time you turn 50, the formula has to completely reverse, which means at age 50, 50% of your earnings has to go for savings and investments. 30% continues to be your discretionary and lifestyle expenses, and only 20% for your daily household needs, right? The whole assumption out here is your salary or your earnings would have increased many folds by the time you reach 50. And the overall amount allocation required for your household expenses won't increase that much in absolute sense, right? So 20% would suffice by then. And a major chunk of your savings should then go for investments to build a good retirement corpus for yourself. So it has to be a dynamic moving formula is what I call it.
All right, fair enough. And keep increasing or stepping up your investments as you go along. We're going to take a very quick break, but this is an interesting chat. Mohit has some more hacks for us on the other side. So we'll continue our conversation about how to simplify our financial life. Stay tuned.